Ever wondered what that invisible force is? The one that can make the stock market either skyrocket or totally tank, like in a single day? Well, it's not magic, I can tell you that. It's interest rates. And this one little thing, this one economic lever, has the power to shape our entire financial world. So let's dig in and figure out how it all works.
Yeah, this is really the heart of the mystery, isn't it? How can a single announcement, we're talking about just a few words spoken out loud, have the power to move billions of dollars in a flash? It's kind of wild when you think about it. But the answer is actually simpler and honestly way more fascinating than you'd probably guess. And it all boils down to one core idea.
And that big idea? Well, it's all about the cost of money. I know, it sounds a little bit like financial jargon, but trust me, it's a really simple but incredibly powerful concept that's behind all this chaos in the markets. So let's break it down.
Okay, so this is the big one, the federal funds rate. This is the main tool the Federal Reserve uses to steer the economy. So what is it? It's basically the interest rate that banks charge each other for these super short-term overnight loans. Sounds simple, right? But don't let that fool you. This one single rate, it's like the first domino in a huge chain reaction that ripples through the entire economy. So you're probably thinking, okay, but what does that actually mean for me or for anyone in the real world? Let's make it super concrete. Picture a business, right? They've got $1 million loan. Now, if the interest rate drops by just 2%, that company saves $20,000 a year, just like that. That's 20 grand they can now pump into hiring new people, innovating, or hey, just boosting their profits. Now imagine that same effect, but multiplied across thousands and thousands of companies. See where this is going?
And that is just the start of what we call the ripple effect. Because this cost of money, it doesn't just hang out with the big banks. Oh no, it spreads out like ripples in a pond, touching literally everything, from a huge corporation deciding whether to build a new factory, all the way down to what's in your wallet.
You can really think of it as two sides of the same coin. It's pretty straightforward. When rates go up, borrowing gets more expensive for everybody. For you, for businesses, everyone. And that means people spend less, companies put their big expansion plans on hold, and the whole economy kind of slows down. But when rates fall, you get the exact opposite. Borrowing gets cheaper, and it's like a giant green light for spending and growth. Everything starts to speed up.
Now, it's not a simple one-size-fits-all deal. Different parts of the market can have totally opposite reactions. For instance, when rates are on the rise, banks and insurance companies can actually do pretty well. Why? Because they make more money on the loans they give out. But on the flip side, when rates fall, it's like pouring rocket fuel on growth stocks. Think tech companies, utilities, real estate. Those guys love cheap money because it helps them expand like crazy.
Okay, but hold on. There's an even deeper, way more powerful reason why stocks can react so violently to this stuff. It's not just about who's spending and who's borrowing. It gets down to the fundamental math, the very formula we use to figure out what a company's even worth. And this, my friends, is the real secret sauce. So here's the absolute key to understanding all of this. When you buy a stock, you're not just buying a little piece of the company as it exists today. No. What you're really buying is a claim on all the profits that company is expected to make way out into the future. The whole game of valuing a stock is trying to figure out what are all those future dollars worth to me right now.
All right, let's unpack this with 3 simple steps. First, we all know that $1 you get tomorrow is worth less than $1 in your hand today, right? So financial analysts have to discount a company's future profits to figure out their value in today's money. Step 2, that interest rate we've been talking about, it's a massive piece of that discount math. And third, and this is the real light bulb moment, when interest rates are low, you don't have to discount that future money as much, and boom, all those future profits suddenly look way more valuable, right here, right now.
Yeah, this quote just nails it. Think about that for a second. Just by tweaking the math, a rate cut can make a stock worth more instantly. We're talking before the company has even earned one single extra dollar of profit. It's not about performance, it's just a powerful, almost mechanical effect on how we calculate the price.
But here's where things get really interesting, and a lot more complex. We have to add a layer of nuance here. See, the market isn't dumb. It's actually really smart. And it knows that the reason the Fed is cutting rates is just as important, maybe even more important than the cut itself. You have to ask, is this rate cut a gift for an already healthy economy? Or is it a warning sign that there's trouble ahead?
And if you look at history, it gives us a perfect masterclass on this.
Let's take 2001, right in the middle of the dot-com bust. The Fed was cutting rates like crazy, but stocks just kept on falling. Why? Because the economy itself was in real trouble. Same story in 2008. The Fed cut rates all the way to near zero, but that didn't stop the financial crisis. But then you get to 2020 and the pandemic. Rates get slashed, tons of stimulus money gets pumped in, and boom, it kicks off one of the fastest, most historic bull runs ever. It just goes to show you, context is absolutely everything.
And that brings us to the final and maybe the most critical piece of this whole puzzle. You see, the market doesn't just react to news, it tries to get ahead of it. It's all about expectations. So if everyone on Wall Street expects a 0.5% rate cut, that expectation gets baked right into stock prices before the announcement even happens. It's already priced in. So what happens if the Fed only delivers a 0.25% cut? The market might actually go down on what seems like good news. Why? Because it wasn't as good as everyone was hoping for.
So, look, the next time you see those headlines flashing about a big Fed interest rate decision, I want you to remember this. The rate change itself, that's only half the story. The real story, the other half, is asking the question, why? Why is this happening now? Is the Fed giving a gift to an already booming economy? Or are they sending up a warning flare because they see a storm on the horizon? Because understanding that difference, well, that's what separates just reacting to the news from having a real strategy.